Hi, everybody, and welcome to our September 24 quarterly tax update. Thank you for joining us for today's webinar. On the call today presenting, we've got John Bland from our international tax team, Sam Mohammed, who is our head of indirect taxes, Mike Kalenova from a manager in our corporate tax team, and myself, Belinda, a director in our corporate tax team. I'll hand over to Mike now to begin today's presentation.
Everyone. It's not strictly tax related, but I think it's important to provide a quick update on the payment times reporting regime. There's been some pretty massive changes recently, so I'll jump straight into it. So for those of you that aren't aware, the payment times reporting regime was introduced in 2021 and requires certain businesses to furnish a report to the payment times regulator detailing the payment timing of invoices issued by small businesses. The overarching objective of the regime is to ensure that small businesses are being paid in a fair and timely manner by big businesses. So a couple of months ago, the entire program was to overhaul completely. So previously, the PTR Act operated by applying concepts kind of cherry-picked from different legislative instruments, such as the carrying on enterprise definition in the GST Act, the total income concept from the Tax Administration Act, and the subsidiary definition from the Corporations Act, to name a few. Unsurprisingly, the combined operation of these concepts in practice resulted in ambiguity, inconsistencies, and confusion for taxpayers and advisors, ultimately leading to the PTR Act to fall short of its desired objectives. As a result of the previous PTR regime, many large groups found themselves having multiple reporting entities scattered almost nonsensically throughout their group, which created onerous twice annual reporting requirements for each reporting entity and hindered the intended operation of the Act. In an attempt to streamline the operations of the Act, the legislative changes have replaced many of the previously existing concepts with those defined by the Australian Accounting Standards Board, such as the concept of control and consolidated revenue. So very broadly, under the new legislation, an entity will be required to provide a PTR report where it is a constitutionally covered entity. So this is the only concept that still leaves a few holes as it relates to entities that fall under the control of the Commonwealth. So the issue here is that a trust that is not established in an Australian territory, which is most trusts, to be fair, can't be subject to the PTR regime. The second point is that it has to have an annual consolidated revenue greater than 100 million, and that's by reference to the AASB definition of consolidated revenue. So before, in the old legislation, there was the concept of a controlling corporation and a member entity, whereby once an entity in the group had 100 million in turnover, it would be considered a controlling corporation, and any entities controlled by this entity would only need $10 million turnover to be included in the PTR group and attract PTR reporting requirements. So this created issues when tracing the turnover for the member entities, as when you hit a trust that isn't incorporated in Australian territory, the tracing chain would be broken. So when this happened, you would have to keep going down the chain until you hit another entity with 100 million, and then you would start the tracing exercise again. The issue here is that there might have been several entities over 10 million that should have technically been caught in that first group that aren't getting subject to the PTR regime at all. And the last point is that it just can't be controlled by another reporting entity. So any entity that satisfies the definition will be required to provide a consolidated payment times report to the payment times regulator, which will include the payment times information of all constitutionally covered entities controlled by the reporting entity. So while this will result in a more streamlined reporting process, hopefully, the revised definition is likely to capture much more subsidiaries of larger groups that were previously excluded due to the flawed operation of the old legislation. Accordingly, in light of the new changes, it would be probably prudent for large groups that are currently subject to the PTR regime to review their reporting obligations in accordance with the amended definition. And in essence, any group that prepares consolidated financials and has 100 million in turnover or greater is going to need to provide a payment times report, which will include, the payment times of all the entities in the group. That's twice yearly. So I've only covered the changes to the definition of what a reporting entity is in this session. However, there were also a multitude of other changes, such as they completely changed the objects of the Act. They removed the notion of a controlling corporation. They removed the notion of a member entity. They introduced a consolidated report. They allowed businesses to align their financial year end with the reporting period, which is an important one because you could only report between 1 Jan and 30 June and 1 July and 31 December previously, no matter what your reporting your financial period was. So that's actually quite helpful. They've increased regulated powers. I'm not sure how exactly they've increased it, but they have said they've increased them. And they've introduced this kind of public name and shame penalty for consistently slow payers. So my understanding is that any payers that are in the bottom 20% in bottom 20% are compelled to publish on their main website that they're a slow small business payer. And on the flip side, top payers are allowed to say that they're a fast small business payer. That's all I've got on payment times reporting. Belinda, did you want to start to discuss your section?
Yeah, thanks, Mike. I'm going to begin today with JAMSEC. JAMSEC's actually a decision of the High Court from last year, but we have had come through in the last quarter the decision impact statement, which is why we're going through it again today. So just as a reminder, the facts there were that there were some individuals and they were engaged as truck drivers. They engaged with ZG operations as contractors. They were, however, originally engaged as employees. I'll just get you to skip over that slide and the next slide. Thanks, Mike. There are some detailed facts on the slides there, but given I'll leave them to be gone through in your own time. The lower courts originally had opposing views on the question of whether these individuals were engaged as contractors or employees, the issue being at stake whether there was leave entitlements payable and also whether super guarantee charge was payable. At the High Court level, the High Court determined they were contractors, and the High Court held that the contractual relationship itself was what prevailed. So in this case, the contract said they were contractors, so they were contractors. It's noted that the Commissioner wasn't actually a party to the original proceedings, but he was joined as a third party when the matter was remitted back to the full federal court for the decision around the super guarantee charge. And the court there ultimately held that super guarantee charge didn't apply. Next slide, please, Mike. In the decision impact statement itself, the ATO accepts that only natural persons entering contracts in such a capacity can be deemed to be an employee for the purpose of the SGC provisions. So that is an individual who engages through a partnership cannot be an employee for SGC purposes. The ATO currently has guidance that that's the case in relation to a company, but this decision, I guess, provides a level of comfort now for partnerships and also potentially for trusts. The ATO reiterated that the contract for the provision of services, contract for the provision of a result is not a contract for labour, which is a long-established principle. It did say, however, that remuneration on a per-hour basis is consistent with a contract for a result, whereas remuneration for the number of hours worked per day is consistent with an employment relationship. Note, however, that the High Court decision in JAMSEC that sort of set out that principle that the contract prevails has been superseded by the legislation. There were changes to the Fair Work Act earlier this year, which now state that we go back to that original multifactorial test that we had before the High Court decision in JAMSEC. Next slide, please, Mike. And the next one as well. Thank you. Next case I'm going to talk about is JMC against the FCT. Again, this is another case from last year, but again, we've just had the decision impact statement released. So I'll run through this quickly. Very briefly, the facts there were that JMC was a provider of higher education. It engaged Mr. Harrison as a lecturer to mark exams and also assignments. Mr. Harrison was paid an hourly rate and he would submit invoices as required. Mr. Harrison was to carry out the services personally. However, really critically, he could engage or subcontract the teaching services if he wanted to, but only with the permission of JMC. So the Commissioner issued notices of assessment to JMC for unpaid superannuation to Mr Harrison. Next slide, please, Mike. And JMC applied to the Federal Court, and the Federal Court found in favour of the Commissioner that Mr Harrison was an employee and that SGC applied. JMC appealed to the full Federal Court and was successful, the full Federal Court holding that he was not an employee. The decision there followed the High Court decision in JAMSEC, which we've just discussed, in that the terms of the contract were what prevailed. In particular, the court focused on that ability to subcontract, and it said that an ability to subcontract is inherently inconsistent with an employee relationship, and that it's the existence of the right that is what matters. It doesn't actually matter whether it's utilised or is likely to be utilised. The court also made comments that they didn't think there was sufficient support that JMC had adequate control over Mr Harrison, and the other factors in that multifactorial test either pointed to a contractor relationship or were largely neutral. The Commissioner did apply for special leave, but it was denied. In the decision impact statement, the ATO accepts that the right to delegate will cause a relationship to fail to be one of employment, and the key determinant being whether that right actually exists. They did note that there will be times where it's difficult to tell whether the right exists, in which case the determination is to be made based on the available evidence. So, for example, if there has been actual delegation. I think looking at JAMSEC and JMC combined, now we obviously have the legislative test, which requires you to look at multiple factors, but it does look now like some of those factors are slightly more important or will, swing the decision one way or the other. Thanks, Mike. On to the Bechtel decision. So the Bechtel decision, so this was handed down in April, although we didn't cover it in our last update, so we'll run through it here. Bechtel was contracted for the construction of a large LNG facility on Curtis Island. Curtis Island is located off Gladstone in Queensland, and therefore it's not remote for the purpose of the FBT concessions. Curtis Island also has no permanent accommodation on it, and so Bechtel was required to fly its employees in and out from Curtis Island to work on their rosters. Bechtel paid for and also organised these flights on behalf of the employees. However, really critically, the employees didn't commence work until they actually arrived at Curtis Island. The Commissioner submitted that the flights were subject to FBT. Bechtel's defence was that the flights would have been otherwise deductible to the employee, and therefore no FBT applied. For those flights to be otherwise deductible, the employee would have needed to have incurred those expenses while they were travelling on work. So that was the key component to this decision, whether the employees were travelling on work. Bechtel lost in the Federal Court in the first instance, with the court holding that because they weren't rostered on until Curtis Island, they weren't travelling for work while they were getting to Curtis Island. This contrasted with the John Holland case from a few years ago, where the flights were held to be otherwise deductible. The critical distinction there was that in John Holland, the employees were rostered on at the airport, and that was where they started their work. So Bechtel appealed that court decision, and again, the court went with the Commissioner. Key to the judgment there were that the employees' respective points of origin were reflective of their personal circumstances and were not a requirement imposed by Bechtel. The employees were not paid by Bechtel while they travelled. Bechtel's assistance in the administration of the travel arrangements, so the booking of the flights, didn't amount to a direction to travel. And the fact that Bechtel had policies that covered the employees' conduct while they travelled wasn't determinative. So I guess coming out of that decision, any employers that have employees who are travelling on sort of fly-in, fly-out arrangements obviously need to review these with this decision in mind. The court's decision is consistent with the ATO's current guidance around travelling on work, which was at the time it was released a little bit of a change in position from the Commissioner. So the court is now in agreement with that. It's obviously very important where the workers are rostered on for determining whether they're travelling on work or not. And it's possibly fair to say that regular travel that is incurred because an employee chooses to live in a particular location won't be classified as being sort of travelling on work, and that there is likely to be an FBT issue there unless the location that they're travelling to is deemed remote under the FBT provisions. It might also be a good opportunity to consider whether it's better to pay an allowance to the employee as opposed to continuing to pay for the flights themselves. Next slide.
Cool. I'll just chat quickly about the changes to the non-resident CGT withholding rules that are in place at the moment. So the federal government have released a bill introducing changes to the foreign resident capital gains tax withholding requirements. So it'll change the foreign resident CGT withholding from 12.5% for sales over $750,000 to a withholding rate of 15%, and they're going to remove the threshold completely. So basically all sales, unless you get a clearance certificate, will be subject to some form of withholding. These changes will apply from 1 January 2025, where royal assent is obtained. However, I understand that they still don't have it. So if royal assent is obtained after 1 January 2025, it'll be the following quarter. So some other changes in this bill include they want to broaden the asset classes to capture assets which have a close economic connection to Australian land or Australian natural resources. So this includes certain leases and licenses to use land situated in Australia. It can include Australian water entitlements and infrastructure and machinery installed on land situated in Australia, which I thought was an interesting one. They also want to amend the point-in-time principal asset test to a 360-day testing period from the date of disposal of a CGT asset. There have been some issues raised there that haven't been cleared yet, but yeah, that's definitely another one to keep an eye on. And finally, they want to have it just include additional notification requirements for foreign residents disposing of assets exceeding $20 million. Is that one?
Thanks, Mike. Moving on to PCG 2024/D2. So this is currently a draft PCG issued by the ATO in relation to personal services businesses and the application of Part 4A. If you just want to go on to the next slide, Mike. So the PCG applies to personal services entities that derive personal services income of an individual. So a common situation here would be sort of an accountant or a lawyer who sets up their own business within a corporate structure. Ordinarily, if that business meets one of 4 tests, for example, the unrelated clients test or the business premises tests, then that income doesn't need to be flowed through to the individual themselves. If it doesn't meet one of those tests, then it's what we call personal services income, and it usually needs to be returned by the individual. So this PCG, it focuses on entities which do meet one of those tests, but the ATO says that even though they do meet one of those tests and therefore the PSI rules don't apply, Part 4A, which is the general anti-avoidance provision, can still apply to deem the income to belong to the individual themselves. So the PCG itself classifies arrangements as either high or low risk, depending on various factors. So indicators of a low risk arrangement are where all the income that flows through that sort of corporate structure ultimately and immediately flows up to the individual themselves who's doing sort of the majority of the services. Another factor is that the remuneration received by that individual is commensurate with the market value for market value remuneration for similar services. Equally, to the extent that remuneration flows to an associate, that is also commensurate with the market value of those services provided. And the 4th factor there that indicates low risk, that any deferral of income, so any holding of the income within a corporate structure or a trust, can be explained. So either it's outside the control of the individual. So for example, it might be held within that structure to acquire a new asset. High risk indicators are obviously the opposite of those. So to the extent that income is distributed to an entity with a lower tax rate, or the remuneration that is received by either the individual or an associate is either lower or higher than the market value for similar services. Next slide, Mike. Okay, now we'll run through some international updates now, which John will do the majority of. But before he comes on, I'm just going to quickly talk about the updates to BEPS 2 and also a new hybrid ruling. So to begin with the BEPS 2 update, just where we're at the moment. Next slide. So the legislation has now been introduced into Parliament. There are 4 acts in total covering off the various rules under the OECD's model. There's also ATO website updates. They've indicated that there will be 4 new returns for taxpayers to lodge, the earliest of those being due on 30 June 2026. Those returns are the Globe Information Return, a Foreign Lodgement Notification, the Income Inclusion Rule and the Under Tax Profit Rule returns, and as well as the Domestic Minimum Tax Return. So a lot more compliance coming in that area. There's also been some further OECD guidance released in the last quarter. Obviously, the OECD has a booklet, I think it's around 600 pages long now, on the operation of the Globe rules. So the further guidance that they've released is looking at the treatment of DTAs and DTLs in the calculation and the ability to aggregate them. And it also gives some guidance to US GAAP taxpayers who will effectively now be required to keep 2 sets of DTAs and DTLs, one for accounting purposes and one for the purposes of the Globe rules. There's also some guidance there in relation to the allocation of current taxes to permanent establishments and also the allocation of profits to flow through entities. Finally, there is a ATO working group now established, and that working group will work with the ATO on things like the design of the returns, what advice needs to be issued, and also the systems requirements to implement this new regime. So a lot still happening in this area, although legislation not yet passed by Parliament. Okay, and just finally, there has been one new ruling in relation to the hybrid provisions released. It is Taxation Determination 2024/D1. It is considered an unusual position for the ATO. The ruling itself clarifies aspects of the meaning of liable entity and also of hybrid payer. So just briefly, the legislation provides that an entity is a liable entity in a country in respect of its own or another entity's income or profits, where tax is imposed on the entity in respect of all or part of the income or profits. So the ruling states that an entity can be a liable entity in a country, even where there are actually no profits or income in that country, or it doesn't even carry on a business there. The ruling goes on to say that the purpose of the section is not to work out which entity does pay tax in a country, but rather whether the entity could be liable to tax in a country. So that clarifies, I guess, an area where there was perhaps some disagreement between on the interpretation of the legislation. The second issue that the ruling addresses is the meaning of hybrid payer. So this is relevant for the purpose of determining whether there's an imported hybrid mismatch. And a hybrid payer is an entity whose payment is disregarded for tax purposes in one country, but it's deductible in another. So the ruling clarifies that an entity can be a hybrid payer in respect of more than one country. And it also clarifies that a non-including country can be a different country to the country in which the payment is made to. So what's that saying is that when you're looking to see whether there is a non-including country, You don't only look at the location of the recipient of the payment. You need to look at all countries to see whether it could possibly be included anywhere, which is obviously a very onerous task for anyone faced with meeting these provisions. Just speaking with some of our international tax team, I understand that the ATO's concern is around entities which the US disregards. However, the ruling seems to apply quite broadly, and there hasn't been any confinement of it to those entities. So obviously still in draft at this stage. Hopefully there will be some relief from the current interpretation. With that, I will hand over to John to continue with the international updates.
Thanks, Mike. Thanks, Belinda. Thanks, Mike. Mike, if you could flip on to the next slide, I'm going to talk about changes that are coming up in the country-by-country reporting regime. So these changes apply only to country-by-country reporting entities. Broadly, they're usually members of what we call SGEs, significant global entities, and that means a global turnover of at least $1 billion Australian. So if you're not in that category, this may not apply to you, but if you're in that category, this is going to be of some interest. So the law to update the public reporting for country-by-country entities is currently before the Australian Parliament. It's been through the Senate Economics Committee, and it's been with some minor amendments has been put through and is yet to be passed, but we're anticipating it'll be passed in the form that it is. So currently, the country-by-country reporting is 3 different statements required to be provided to the Commissioner, and they're going to remain, but a new reporting requirement is going to exist, which is for public country-by-country reports, which will be on a different form, but when they're filed, they'll be made available at a certain time in the year on a publicly accessible database by the Commissioner. And if you're in this category of taxpayers, SGEs or country-by-country reporting entities, very high penalties for things like failing to file on time. So just be aware that that will continue in this area as well. Mike, if I could get you to go to the next slide, please. Sorry, that one, yes. So there will be a de minimis threshold for this public reporting in the situation where the Australian economic activity is less than $10 million or $10 million in Australian income. They will be exempted from having to provide the public CBC reports. The approach that's being adopted in Australia broadly follows the approach taken in the EU from 2022, and it's based on the Global Reporting Initiative, or the GRI 207. The way that it's going to work in Australia is that if you're in certain specified countries, typically low tax or other countries on the list that the ATO publishes, information about those arrangements need to be reported on a country-by-country basis. However, where you're in the less concerning tax jurisdictions, there will be an ability to aggregate some of the public country-by-country reporting information. So, Mike, if we just go to the next slide, this shows what will be required to be provided to the Commissioner and what will be published on the Australian Commissioner's website. The details there are maybe not surprising, apart from the top right-hand side there, the description of the group's approach to tax. That may be new for some taxpayers. This is again based on this Global Reporting Initiative 207.1, and I'll talk about that in a sec. The other one is down the bottom left, the reasons for a difference between income tax accrued and profit before tax multiplied by the country tax rate. An explanation needs to be provided for that, which could be quite complex depending on what's going on. So, Mike, if we just go to the next slide, just an extract from Global Reporting Initiative 207.1, an approach to tax. These are the sorts of things that need to be considered and reported appropriately in the public country-by-country reporting documents. So it's whether there is a tax strategy, is it publicly available, what is the governance body or executive level that oversees and approves and reviews tax strategy, what is the approach to regulatory compliance, and how the approach to tax is linked to business and sustainable development strategies of the organisation. So some of this is new and will be required to be made available to the Commissioner. Just although the law hasn't been passed yet, just to confirm that if it's passed as currently stands, this will apply for periods commencing on or after the 1st of July 2024. So you may already be in that period, depending on what your financial year period is. So just be aware that this is coming, and it will be passed as we anticipate, based on what's currently before the Parliament. So Mike, if I just get you to move on, please, and the next one from there. Thank you. Just one more, Mike. Thanks. The next thing that's changing is the short form local file, which is one of the 3 documents that gets filed with the Commissioner. So Mike, if I could get you to go on to the next slide. Okay, I'll keep going. Historically, the short form local file is filed along with some other broader information, local file Part A and Part B, and it covers 5 major areas: organisational structure, business and strategy, business restructures in the year, any transfers of intangibles, thank you, and key competitors. It's in a free text-based form, and it can be lodged with the Commissioner with the other country-by-country reporting documents. This is now going to be changed, and it's going to be made put into the message structure table format that the other local file Part A and Part B is in, which you'll be familiar with if you've been filing those in Australia. The understanding we get from the ATO is that the reason for the change is to address gaps and inconsistencies in information that's currently being provided. And as I said before, it's a free text form, the other version. And so, the level of detail is obviously going to vary between different taxpayers. So this is an attempt to try to systematise that process. So Mike, if we could go to the next slide. The ATO is saying that this should reduce compliance for some taxpayers. However, in the situations where you have certain things going on, there'll be up to 52 proposed new questions. Sorry, Mike, could we just move that slide on?
Sorry, it's moved on my screen. You've actually frozen on my screen, so I'll just maybe stop sharing and reshare really quickly.
Okay. I'll just keep going. The ATO has recently reduced the potential number of questions that are going to be asked, particularly around specific names and tax residency information for overseas individuals. That's going not to be included, but the rest of the short form local file is still going to be, as we understand, changed to reflect this. These changes will be from 1 July 2025, and they can be reviewed on the Australian ATO website. So one of the changes that we are seeing is that we have to provide details of each business line rather than just the overall business. And if you have different business lines, there'll be a set of questions for each business line. So just be careful that that is going to be a change. If you don't have some of these things going on, people reporting overseas or restructures on any new intangibles arrangements, it will be probably less burdensome than the current format. However, if one of these things does apply to you, it will be greatly increase the amount of compliance that needs to be done. There'll be questions, detailed questions on each of the areas that need to be filled in and completed in the message structure table. So, Mike, if we go to the next slide, thank you. These are going to apply for reporting periods. Again, we're already in one from 1 January 2024 and statements lodged from 1 January 2025. The actual document, the XML schema isn't available yet, but we're anticipating that will be made available towards the end of the year or starting next year. And just finally, one more slide, Mike. Thank you. The probably important points to note are that there is an ATO on financing and IP issues, which you may be familiar with. This is going to be embedded into this new CBC reporting format. More complex disclosures, particularly for restructure. If you're familiar with step plans and restructures, each step of the plan will need to have questions answered around it and specific information provided for each step, as well as attaching a copy of the actual step plan to the local file when it's lodged. So it could be a major increase in compliance, depending on what's going on for you. but it's going to start from 1 January 2025. And with that, I'm going to wrap up. Thank you, Mike, and I hand over to Sam.
Yeah, thanks, John.
Cool.
If you could flick to the next slide, Michael, and the one after. So it's been quite a busy time in indirect tax. We've had a number of really important cases that have come out. So I guess in the interest of keeping the indirect tax section of this session to 15 minutes or so, we picked a stamp duty case and also a GST case, but we will, I think, in the next session cover off on the Uber decision, which is a very important payroll tax case, and there's Automotive Invest, which is a High Court decision around luxury car tax. And given we don't generally get a lot of luxury car tax decisions, particularly at the High Court, that will be one to debrief on in the next session. So Oliver Hume, for those who are unaware of this case, this is the landholder duty case out of Victoria. That said, given the landholder regimes that apply across all of the Australian states and territories are quite similar, we'll have broad applications, so not just in Victoria, but Queensland, New South Wales, WA, they all use very similar wording in terms of how their landholder duty provisions apply. So for those unfamiliar with landholder duty, it's essentially it's stamp duty that applies on an indirect transfer of land. So when rather than a direct transfer of the actual land itself from one party to another, it applies where there is a transfer of an interest in a company or a trust that itself holds land above a certain value. In this case, the taxpayer, which was Oliver Hume Property Fund, was a special purpose vehicle that was set up by the broader Oliver Hume Group, and it acquired a property in 2011. It had some funds that were lent to it by the parent entity, and in order to, one, pay back that loan, and two, have sufficient funds to undertake the property development, it put together an information memorandum and put that out to select potential investors that were previous investors in Oliver Hume projects or were known to Oliver Hume, as potentially wanting to be involved in property development. So went out to a reasonably large number of potential investors, and it was subscribed to 99.99%. The highest investor, I think, took maybe about an 11% interest. The lowest took about a 2% interest. There were 18 different investors in total. Now, those 18 different investors weren't related to each other. They weren't associated persons. So they weren't aggregated on that basis. But each investor individually didn't take what's called a significant interest. So typically, landholder duty only applies where a significant interest, generally 50% in a private company, has been acquired. The flip side of that is where it's less than 50% being acquired, generally there's no landholder duty payable. Mike, if you just want to flick to the next slide. So the issue in this case is that there are aggregation provisions in each of the relevant landholder duty rules that effectively say that where acquirers are acting in concert together, or where the transaction is substantially one arrangement, then the sum total of all of the transfers will be aggregated and will be treated as if it was a single transaction of, in this case, 99.99%, which is more than the 50% threshold. In the original tribunal decision, they considered what was relevant was that the information memorandum was sent out at one particular time. So there was, I guess, a unity in terms of the timing of when people were looking at the investment. And then also there was a deadline of the investment itself. There was a single purpose, which was for I guess, a single development of the property. All of the investments were interdependent on the fact that there needed to be a sufficient amount of capital raised, in this case 1.8 million. If that capital threshold was not reached, then the development wouldn't go ahead, and all investment funds would have been returned back to those potential investors. And also at the end of the development, all of the investors would essentially take all of the returns, and the fund would be wound up. So there was I guess a common timing, both in terms of when they invested, but also when the exit occurred. And when the tribunal looked at all of those factors, it decided that there was a substantially one arrangement, because there was a unity of purpose amongst all of the investors, notwithstanding the fact that those investors, again, they didn't know each other, they weren't acting together, they were acting separately, but because the transaction itself was seen as one arrangement, landholder duty was payable on the collective of the 99.99% interests acquired by all of the investors, which is effectively a second round of duty. There would have been one round of duty when the SPV acquired the property, second round of duty when all of the investors then came in, which was obviously not an outcome that the taxpayer was after. So they then appealed to the Court of Appeal in Victoria, and the Court of Appeal essentially looked at the same factors and came to the same conclusion. Sorry, Mike, if you just want to flick to the next slide. The Court of Appeal essentially came to the same answer as the Victorian Administrative Tribunal, that the parties weren't acting in concert with each other, which requires that the parties or the acquirers having a subjective intention of working together. That's not what occurred here. What occurred here was objectively each investor was a player in a single or substantially one arrangement. So that was the finding of the court. I believe it hasn't been appealed any further, so this might be the end of the line for the decision. And I guess taking a step back and working out, well, what does it mean for future investments along these lines? It potentially means that there's an additional duty cost that might have to get factored into the returns, because typically these types of investments, because no single investor will take more than 50%, duty hasn't always been paid on these types of arrangements, whereas now there's ammunition for the revenue officers to kind of look at this case and say, well, if you have a commonality of purpose in terms of a single information memorandum, you're working on a single project, all of those interests from very disparate investors could be aggregated and treated as a single transaction. I guess other key points to note is that landholder duty is a liability that would be joint and several between each of the investors. So notwithstanding that you might have a single investor taking a 2% interest in a property, they could potentially be up for duty on 99.99% of the duty liability in this case, because that was the sum total of all of the interest transferred. So, your liability as an investor could well exceed your actual investment itself. And if the investors themselves don't pay the liability, then it's a liability that also gets shifted to the landholder. So the commissioner would be within his or her rights to put a first charge on the land, sell the land out from underneath the landholder, and then take the proceeds to pay off the duty liability. So I guess it's something to be very mindful of. Victoria has actually announced a voluntary disclosure program for those investments that fall within the scope of similar facts of Oliver Hume. The Victorian Commissioner has said, now's your time for voluntary disclosing it. There will be no penalties and reduced rate of interest. Interestingly, New South Wales hasn't yet accepted the decision, so it's unclear whether it will be interpreted in New South Wales along similar lines. Queensland, I believe, informally has always sought to treat similar arrangements as being aggregated along the lines of Oliver Hume. So it'll be interesting to see how the revenue officers outside of Victoria implement this. But certainly a very strong case for the Commissioner to take forward and impose landholder duty where historically it hasn't always been applied. If you want to just flick through to the next case, Mike. The next case is a GST case. So it's Connie as trustee for the William Lewski Family Trust against the Commissioner. And this the case itself has a lot of unique facts, and we won't necessarily go through all of the unique elements of it, but there are some, I guess, general concepts that have been considered and reinforced in this case that I think apply more broadly to a much wider range of clients and taxpayers. So what, maybe if you flip to the next slide, Mike, what this case was about was whether the taxpayer, which is the trust or Conibata, whether it was entitled to claim back the GST as input tax credits on various legal fees that had been incurred, which related to legal proceedings which had been initiated against various other members of the Lewski family group. So the common person and I guess controlling mind of all of this was William Lewski. He was a director at various times of the trustee company. He was also the specified beneficiary of the trust. He was also, I guess, the patriarch of the Lewski family group, which also included his wife and their 3 kids. And within the family trust, there were a number of related companies that were listed as general beneficiaries. And essentially, there were various legal proceedings which were ongoing against members of the Lewski family group and various companies related to them. And what was put in place is that instead of the family group directly engaging the legal service providers, there was a series of litigation funding agreements that were executed between the family group and the trust, pursuant to which the trust agreed that it would go out and procure and pay the lawyers. It would then package it up as some form of strategic advice that would then use to provide to the family group in terms of how to take forward those legal proceedings. And in return for agreeing to pay for all of these costs, what the trust received in return was essentially a promise from the family group that if it was successful in obtaining any costs or court orders in its favour, it would pass the benefit of that back to the trust. So, for instance, if the family group received a cost order entitling it to receive $1 million, it would pass the benefit of that back to the family trust. And that was essentially the argument as to what the consideration was for these litigation funding agreements. So if we go back one slide, Mike, effectively that raised 2 issues. The 2 issues were whether the trust in this case was seen as being the entity that acquired the legal services. So rather than each of the family members acquiring the services themselves, was it in fact the trust that acquired the services? Or was the trust simply a third-party payer? So a third-party payer is not an entity that actually acquires something, it's just someone is paying for someone else's costs. And where you have a third-party payer, then that entity, the one making the payment, is not entitled to an input tax credit. The second question was, even if Conibata or the trust was successful in arguing it was the one that incurred the legal services, it still needed to get over the threshold of satisfying the court that it was carrying on an enterprise. So you can see there that the decisions at the originating court, which is the single judge of a federal court, was that the taxpayer won on the question that it acquired the legal services, but it lost on the second question that it was not seen as carrying on an enterprise. And because the taxpayer needed to win both issues, it lost the case. It then appealed on the enterprise question, and the Commissioner appealed on the acquisition question. Now, what the full Federal Court did is it answered the second question and agreed with the tribunal that the taxpayer was not carrying on an enterprise, which meant that it didn't need to consider whether it was the entity that acquired the services. So if we just flick through again, Mike, to the next slide. So what the full Federal Court looked at in terms of answering the first question as to whether the taxpayer did in fact acquire the services. So it looked at the underlying contract that had been agreed with the lawyers. It was in the name of the taxpayer, the trust. It was also the same party that was making payment of those costs. All correspondence and all negotiations were being undertaken by Mr. Lusky. Now, the lawyers themselves weren't clear as to in what capacity Mr. Lusky was undertaking those discussions, but the evidence was, on balance, seen as Connie Barter, the trust, was the entity that acquired the legal services, even though it was not a party to any of those legal proceedings. The second question around enterprise, the court held that simply incurring a cost is not the enterprise. So the fact that the trust went out of its way to engage lawyers and other advisors was not in and of itself an enterprise. Now, interestingly, the trust did actually carry on an enterprise, which was completely unrelated to this legal services arrangement. It provided various advice to retirement villages and home care operators in respect of their operations. So that's got nothing to do with this. So the court was satisfied that the taxpayer did carry on an enterprise, but these costs were not incurred as part of that particular enterprise or any other enterprise. So the court considered that, look, there was an air of artificiality about this entire arrangement, because when you kind of work it through, effectively we're turning costs, legal costs, that would have not been otherwise recovered if directly incurred by the family members because it was a private matter. And we've somehow managed to kind of package it up and allow input tax credits if the taxpayer's argument was correct. One of the other points that was interesting to note as to that kind of played against the taxpayer was that the taxpayer himself was actually Mr. Lusky, sorry, was a tax agent who was quite familiar with GST. So I think there was an implicit statement that this was a new and novel way of trying to over-recover GST credits when, in fact, none should be recoverable. So, on balance, the court decided that the trust was not carrying on enterprise simply by incurring these costs, that because there was a very low chance of success for the family group members actually receiving any costs order. I guess, interestingly, in most of the proceedings, the family groups were in fact the defendants, so the chances of actually getting any costs awarded to them above and beyond their own legal fees was close to zero. So the court decided that in and of itself didn't create an enterprise, and therefore the taxpayer lost and couldn't retain the input tax credits that it had sought to claim. So I guess just taking a step back, the kind of key takeaway is just because you incur a cost or make payment for a cost does not entitle you to the input tax credit. Generally, what you need is consistency between which party is the party that has gone out and engaged a service provider. So you need to be the one that's listed on the engagement letter or contract. You also need to be the same entity making payment, and you also need to be the entity that receives the tax invoice. So consistency between all three. So when you have one or two out of three, that's a red flag that potentially your input tax credit is not being, or you may not be able to get the input tax credit. So if you've got one entity listed on the engagement letter, but another entity, even if it's a related party, is making payment, then potentially neither entity is going to get the input tax credit. So I guess this case just reinforces the importance of ensuring that care is taken in terms of who engages a supplier and who actually pays for that supplier and who receives the tax invoice for the final payment. So I think that covers all of the content. Just wanted to thank my fellow speakers, Belinda, John, and Mike. Also, just wanted to thank the audience for joining. So appreciate it, and we look forward to seeing you at the next session. Thank you.